Hey everybody, welcome back to the channel. We are back on another episode of Daily Palantir, and on today's episode, we have one thing and one thing only to discuss. New Palantir downgrade from Jefferies analyst Brent Thill to $13. There is a lot of components to this downgrade, including not only the stock action, but some of the logic behind his report, and some of the things I think people are missing, but also some of the things that may happen as a result of this downgrade. Let's get into it. All right, so first thing, let's just talk about the downgrade and what his argument is in and of itself. So if we go here, this is the downgrade. Brent Thill downgraded Palantir Technologies from hold to underperform with a price target of $13 from $18. Now, what is his logic for this downgrade? This is essentially what he says. We are still fundamental fans and believe that the company has the potential to gain share in an underpenetrated and large total addressable market, but think concern over top-line growth will be the primary driver of stock performance over the next 12 months. He again lowered his rating to about $13 per share. While he noted that the AI story around Palantir is likely overdone, Thill conceded, however, that the company offers a highly differentiated platform that companies can use their specific data analytics needs. The key issue, though, is whether it can get out of its own way, as it has faced some execution problems in recent memory. He says Palantir has faced some execution issues over the past several quarters, with the growth stalling in both its government and commercial businesses. We believe that the key debate is focused on whether Palantir can solve its go-to-market problem and re-accelerate its U.S. commercial growth, which is its largest growth opportunity ahead. He also says, while we do believe the company has an AI technology advantage in the long term, we are concerned that the stock has rallied to unsustainable valuation levels, primarily on the back of AI euphoria and retail trading momentum with no monetization strategy. If we look at the price right now, we're at $15.99. This is actually way better than it was in the pre-markets. This report came out about 8 a.m. As you can see right here at the bottom of this big green candle, we were at $15.67. So we bottomed out around 4% down. Now it's $16, $15.99, down about 1.6% of the day. We'll see how the day ends. We still have a couple hours left to go in the trading day. But so far, we have recovered from those lows of $15.67 back up to this $16 level. And the price target downgrade has not been proven to be a downgrade that creates further momentum on the downside of the stock, because there were enough buyers waiting to buy it at $15.60, $15.70, $15.80, and even $15.90 in order to get the stock to bounce back up to that $16 range. So let's discuss and break down what this guy is trying to say and what his argument is in the first place. First of all, Brent Thill is someone who has been bearish on Palantir for a long time. The last time we heard from him was on the Q4 2021 earnings report, where he actually asked Palantir a question, and you could tell the way he asked the question, he was always very skeptical about their sales, go-to-market strategy, etc. So he's been someone who's been, I wouldn't want to say bearish, but someone who's just not been excited for Palantir's and their go-to-market strategy in regards to the AI space for a while. So it makes sense that he has this downgrade. Second thing, let me give the bull case to his downgrade, and then we'll give the bear case to his downgrade. So first of all, let's give the downgrade all the credence it needs to sort of build up the argument. Brent is not arguing that Palantir doesn't have an AI moat. He's not arguing that they don't have a differentiated value proposition in regards to operationalizing AI throughout the enterprise via their AIP platform. He's not arguing that they don't have a unique product that fits within different subsets of the AI market that has a niche offering that can be ultimately more general and scaled through the commercial space, because he acknowledges their commercial growth. What he is saying that is wrong about the price right now on Palantir, and he put this price target out when it was at 16. It's funny he didn't put the price target out when he was at 21. We'll talk about that in a second. But nonetheless, his argument right here is Palantir is overvalued because of the sales risk that exists in terms of their go-to-market and execution strategy. So I want to make this very clear. The bull case for his downgrade is not that Palantir is not an AI product, or that it's not real generative AI, or that there's no real technology component built into the nature of the software, because I think even he is smart enough to realize that's not a good argument, and that's probably not an argument you're necessarily going to win, right? Calling Palantir an AI imposter is not really the best argument. But his argument is that the go-to-market strategy is flawed, and that there's a problem with the sales, and as a result, if there's a problem with the sales, there's a problem with top-line growth, and you can't give a multiple to this top-line growth. From that perspective, he is not wrong. I mean, let me make that very clear. Brent is not wrong from this perspective. He is acknowledging Palantir as a product that is very viable and can become incredibly useful in the broader ecosystem of AI and what the market is looking for. The problem is, his argument is that there is a lack of go-to-market because of the sales growth rate. Now, this is why he's correct. I mean, the growth rate speaks for itself. You cannot have a stock that's trading at some of the multiples it was trading at back when it was at $21.85, which is why Peter Thiel dumped shares, Shyam Sankar dumped shares, Stephen Cohen dumped shares, Alex Karp dumped shares. All these guys sold at the high 20s or the $20, $21 range because they even knew themselves. I mean, like, it does not take a genius to recognize when a stock is ridiculously overvalued because the premium that is being put on the stock simply cannot make sense with the growth of the stock. If Palantir was even growing at 22, 23, 24, 25% year-over-year growth, you could probably justify a little bit more of that multiple, but under 20%, it's just hard to get that growth for a high-growth tech company that's not necessarily growing. So his argument is correct that the sales multiple that we put on Palantir at that $18, $19, $20 range, given the lack of growth, made it obvious that the company is a bit overvalued. And it's not a problem with the company itself. It's not a problem with the AI. It's not a problem with the technology. It's not a problem with the ability for them to actually operationalize workflows for the enterprise. It is a problem with the go-to-market strategy because in the numbers, there is no growth or not the level of growth that you need from a high-growth tech company. Now, the bear case for his downgrade. That's the bull case. The bear case for his downgrade is a couple of different things. Number one, the timing of this is highly suspicious. I mean, when Palantir was rallying up to $21, Jeffries obviously should have put out this report because if their price target is 13, there's no way it can be sustainable at 21. They didn't put out this report because they probably knew they would have looked stupid if they put out this report. So that's why they didn't do it. Makes sense. That's why they didn't do it, right? No one wants to look dumb when like this stuff is happening. So I get why they didn't do it at the time. But the timing now when Palantir has already fallen from 21 to 16 and you're like, now it should go to 13. The reason I'm bringing this up is because it seems likely, this just happens on Wall Street, and this is not definitely true, not definitely wrong, but a lot of times these analysts put out reports to be able to get better price targets for their friends on Wall Street. And that's just the God honest truth of it. That's not a tinfoil hat. That's not a conspiracy. This is how analysts operate. It's not how every analyst operates, but a lot of times the timing of these reports are incredibly suspicious because if there's already downside momentum on a stock, well, if I could tank it another 5, 6, or 7% and get an even better price because I want to pay 14 versus $20, then, you know, you'll have an analyst come out with this report. So in general, I didn't really like the the timing of the report, and I think that's one bear case to say. One other bear case on this analyst is he is ranked 8,317 out of 8,647 on tip ranks. The guy objectively is not that good at analyzing stocks. I mean, he has an average return of 5.9% for every call he makes. So from that perspective, he's also not the greatest person to listen to when it comes to his calls on stocks. Now, the other bear case of his report is that his argument is, okay, Palantir has a sales execution risk, therefore their go-to-market is flawed, and that's why you can't give them a massive multiple on the stock. He is only correct in the context of the growth rate being significantly lower than the multiple is implying. Therefore, he is correct. The stock theoretically should come down. I don't know if $13 is the right level. To me, $15 is truly fair level, and I've been saying that even when Palantir was at 21, that $15 has been pretty fair value. That's where I want to buy the stock. But his argument is the growth rate does not match the multiple. The problem with this argument is that all the evidence I've seen, I don't have any insider information. You guys don't have insider information. Everything we're seeing that is publicly available about Palantir's new and refined go-to-market approach via the bootcamp strategy is making me very, I guess, optimistic is the best word I have, that they are figuring out this sales strategy. And that's where I think his downgrade is kind of flawed. Now, look, look, if the downgrade gives me better prices to buy, then so be it. But the problem with the logic behind the downgrade is that their go-to-market strategy is so incomplete that they don't have the ability to actually grow. He's either going to be right about this in the next 3 quarters or wrong about this. So far, he's right, but he's not necessarily right because of their go-to-market. He's right because the growth hasn't been there. Palantir's pitch to investors has been, look, we sucked at sales. We know we sucked at sales. You guys obviously love our product. You believe in the technology of our product. We believe in the technology of our product. We just need to figure out how to sell it. And over the past 6 months, this bootcamp strategy, which has resulted in over 1,000 participants, 27 different industries, over 450 boot camps, they've done a lot of work in changing how they bring their product to market for a market that is dying for their type of product. So from that perspective, I think the logic of the downgrade only makes sense if you purely look at it from numbers. Like, yes, the growth rate is so low that the multiple can't be justified, so the stock probably should come down. But it is not justified in terms of the future potential of the stock, which is what these analysts I thought were supposed to be looking, which is forward look at the future potential of the stock. And if the future potential of the stock is that the company is going to be able to massively change their go-to-market strategy, and we will see in the next couple quarters if that growth strategy actually works, then the growth is going to be there from the bootcamp strategy, from the go-to-market, which will ultimately lead to a higher multiple in the stock because that top-line revenue number will grow. In fact, in my 2024 expectation videos for Palantir, this is exactly what I said. I want to see top-line revenue growth. And, you know, I know it's silly because every shareholder wants to see growth for their company, but my argument was that the multiple is getting to the point where it you really can't make sense of it in the context of the growth rate. So if we can just get that top line revenue growth to increase, at least the multiple will normalize, if not go higher, and you can justify that Palantir deserves to be at these levels, because, you know, the argument against every bear on Palantir is like, well, they're not growing, even if the technology is phenomenal. And so from that perspective, I do think he has a point. The problem is I think his point is going to be undermined as Palantir starts to execute on their go-to-market for bootcamp. There's been plenty of videos I made, plenty of analysis I made. I have a new a Substack, DailyPalantir.substack.com. In the newsletter every day, we talk about different ways in which they're approaching their go-to-market strategy. And that go-to-market strategy, to me, is being refined, and we are going to see in the customer count numbers over the next 3 quarters if they can actually execute and build up their customer count. And so far, everything I've seen with the Fujitsu partnership, with the Plascred partnership, with the Unicred partnership, they closed one of the largest home manufacturers in the United States within 90 days. That would be a contract. That was a $40 million contract that would have taken probably 7 or 8 months in the past. Like, things are changing, and customers are excited for these boot camps. And now it's just a question of if in the numbers that can change. Final thing I want to say here as well is that Palantir is not alone as a high growth tech company that is tech but not high growth. Amazon at one point was a high growth tech company that was not growing. Netflix was at one point a high growth tech company that was not growing. Tesla was a high growth tech company that was not growing. All these companies at one point of their life cycle were classified as high growth tech and implied by their multiples, but they weren't showing the growth to be able to justify the high growth tech part of the multiple. Palantir's in the same position. I mean, goodness gracious, look at Apple. Apple is a high growth tech company that has a 31 forward PE. Now it's probably a little bit lower since they're down about 6% this week. And they're not growing. They have negative growth. Now, obviously, Apple can buy back shares and they can manufacture their EPS, and they have all these different things they can do because they're Apple. They have, like, you know, a couple $100 billion in cash, but they're not really growing. So why are investors paying this forward price to earnings for something that's not growing? Palantir is in the same position, I believe, as a lot of these tech companies were in the early stages of their life cycles, which is why it's so exciting to bet on a company like Palantir, which is why we're all excited to bet on a company like Palantir, because it's not Amazon yet, it's not Tesla yet, it's not Nvidia yet, it's not Apple yet, but it is at that stage where they're trying to figure out how do they get to that point, and sales and distribution is one of the biggest components of figuring that out. They already have the tech part of it figured out, and I believe, given they're not acquiring companies like Snowflake had to acquire 4 companies last year, they're always going to be able to innovate and keep building new products. They just need to figure out sales. So Palantir is not alone as a high-growth tech company that's not growing. Every company at one point that was high-growth tech and ultimately exploded was at one point not growing, and they had to figure out how to grow. It is the trials and tribulations of being a high-growth tech company in the public markets. How do you actually grow? How do you make it real? And Palantir's trying to figure it out. So from my perspective, this downgrade is not that concerning. This downgrade is pretty obvious. It was going to happen. The timing of it is also suspicious, but it is what it is. You would imagine that would happen as the price starts to fall down. Right now, Palantir at $15.97. Look, if you're a long-term shareholder like me and you want these shares legitimately to give to your kids, you want 15 versus 20 bucks. You'd rather pay $14. You'd rather pay $13 versus $22. So from my perspective, it's actually not the worst thing in the world, quite frankly. And again, his core point is not that the technology has a problem. His core point is that the sales go-to-market strategy has a problem. It's just kind of a boring argument because they've done so much work to change their go-to-market strategy. And now if I was an analyst, I wouldn't even issue an upgrade or a downgrade. I would just be like, all right, let me see the numbers. Like, I will give you 2 quarters or even at least 1 quarter to see if your bootcamp go-to-market strategy is working. If it's not working, I'll downgrade you. But at least wait till it starts working. The problem is he never even waited to see if it's working, which is going to take a couple months to see those numbers in Q4 earnings. He just decided to issue the downgrade on the assumption that it's not working. So maybe he has some information that it's not working. I would argue that he's just kind of saying this to say this at the end of the day, because none of us really know if it's working, and we will see in those Q4 numbers. So yeah, that's it. Let me know your thoughts on this analyst downgrade for a Palantir. $13 price target at the end of the day, not the biggest deal in the world to me, but some part of his logic makes sense around the boot camps, around the growth not being there. It's just, I think the boot camps and their growth strategy and their go-to-market eventually is going to change that for their growth. That's it for me. Thank you, everybody, for joining. We'll talk about this more on Palantir Weekly today. Subscribe, DailyPalantir.substack.com. Free email newsletter every single day. And I will see you guys on the next one. Bye-bye.